Why do 95% of the USA population receive education on credit? In 2023, American students will cost their families dearly. The amount of about $130,000 for 4 years of study is expensive for the average American. Therefore, many young people and their parents are considering such an option as getting a loan from a bank. Among the most popular types of loans among students are PLUS, Stafford, and Perkins. The education loan policy also provides an opportunity for students to start paying off the loan only after graduation and work in education. This is the simplest and most convenient credit system for education in the whole. Education on credit is important in America because credit is a fundamental aspect of the country's financial system and plays a crucial role in people's ability to access credit, make large purchases, and accumulate wealth. Understanding how credit works and how to manage it responsibly is important so that people can successfully navigate the financial system and achieve their financial goals. In addition, credit education can help people avoid falling into debt and financial problems and can also give them the opportunity to make informed decisions about their financial wealth. The credit system in the United States has evolved over time and has been shaped by various economic and regulatory factors. Here is a brief overview of the history of the credit system in the Early America. In the early days of the United States, credit was primarily based on informal arrangements between individuals and merchants. Traders, farmers, and craftsmen relied on credit from local merchants to finance their businesses. Industrialization and urbanization. The 19th century saw the rise of industrialization and urbanization, which led to the development of more formal credit arrangements. General stores and local merchants extended credit to consumers, allowing them to make purchases on account and pay later. Introduction of credit reporting. In the late 19th century, the first credit reporting agencies, such as retail credit companies, were established to collect information about individuals' creditworthiness. These agencies provided lenders with the necessary information to assess the risk of extending credit to borrowers. Emergence of consumer credit. The early 20th century saw the emergence of consumer credit in the form of installment loans and revolving credit. This allowed consumers to purchase goods and services on credit and pay for them over time. Regulation and legislation. The 20th century also saw the introduction of various laws and regulations aimed at governing the credit industry. The Federal Trade Commission (FTC) and the Fair Credit Reporting Act (FCRA) were established to protect consumers and regulate the collection and use of credit information. Rise of credit cards. The 1950s and 1960s saw the widespread adoption of credit cards, which revolutionized the credit industry. The introduction of national credit card networks such as Visa and MasterCard expanded access to credit for consumers and businesses. Subprime lending and financial crisis. In the early 21st century, the housing market boom led to the proliferation of subprime lending, which eventually resulted in the financial crisis of 2007-2008. This crisis prompted reforms in the credit industry and led to the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Throughout its history, the credit system in the United States has been subject to constant evolution, driven by changes in the economy, advances in technology, and shifts in regulatory and consumer protection measures. Today, the credit system is a complex network of lenders, credit reporting agencies, and consumers, with various laws and regulations in place to govern its operation and protect consumers' rights.